Okay, good afternoon, everybody. Welcome to this webinar on mutual funds by NISM, National Institute of Securities Markets, which is an educational initiative of SEBI, Securities Exchange Board of India. So we, of course, have got a very huge response in terms of attendance to this webinar, and the profile and the experience and the education level has a broad range. So some of you may find some of these things basic, some of you may find these things advanced. I will try to keep it balanced in between, that it doesn't become very basic also, and it doesn't become too advanced also. So those who don't know anything will probably have to come up to a certain standards, and those who know a lot may have to moderate their expectations. Of course, you can always ask your questions, which will be after the presentation is over. So I'll start. Basically, as I said, we are on the mutual fund. So just as a refresher, while we don't have it as an interactive right now, except in terms of typing your questions and answers, which also you can do. But at your end, just think that what are the two most important assets in one's life. And I'll just stop for some split seconds to give you time to think. There'll be a lot of answers. There'll be family, our children, our education, a lot of things, our house, our car, our spouse. So a lot of assets are important. But as I said, which are the two most important assets? By the time, in the meantime that you think, let me go on to the second slide. And here the question is that what are the two assets about which one is generally most careless? So try to think of answers to both these questions, different answers to different questions. So again, here, there will be multiple answers, that what are we careless about? We care less about not being fit. We don't care about our regular exercises. We sometimes don't care about our friends. We sometimes don't care about our office work. We sometimes don't care about replying to messages or emails or things like that. But let me take you ahead. So somebody has given answer here, healthcare. One answer, okay. And second, somebody has said savings is the most important. Somebody has said education and knowledge. Somebody has time is most important. Somebody has said time and health. So okay, let's move on. I'll just take you through the next slide. So the answer to both these questions is same. It's not different. And the two simple answers are health and wealth. So as I said, people did respond in terms of health. Somebody said savings. So let me categorize that savings broadly as wealth. So just go back and think that while the two most important assets in our life are health and wealth, unfortunately and ironically, these are the two assets about which generally we are most careless also. If our shoe breaks, we immediately get the help of professional. So what do I mean by professional? Cobbler is a professional. We give him some money, we get it repaired. A fridge or a TV or even our mobile doesn't work, we immediately take it to technician or call him and get it repaired. So when it comes to these things, which are indeed important, we immediately take professional help, we pay fees, we pay money and get them repaired. Now think, why don't we apply this to health and wealth? When it comes specifically to wealth, we think we know everything and we'll be able to manage. Well and good. If we know, if we are able to take care, very good. Similarly, health also, of course, it's not always practical, but when it comes to health, if we are sick, we try to take some medications here or there, ask some friend, ask family, we'll go and look back in our old prescription of doctor. Last time I had this disease, what medicine I took. We go and ask the medicine shop guy that, okay, give me some medicine. That's being careless. As I said, it's not practical also that for every small disease we immediately go to a hospital, get ourselves admitted and start consulting a very high level of consultants and doctor, and it's expensive also. But beyond a certain stage of, let's say, 2 days, 3 days, if a disease is not getting repaired or not getting okay, it is necessary that we take professional help. So our topic is mutual fund. I can talk about these things on and give you a lot more examples and make you realize. But now also and post this webinar, think about these things, that the two most important assets in our life are health and wealth. At the same time, generally, most of us, not all of us and not always, are most careless about health and wealth, while we are very careful about relatively smaller things. I am not saying mobile is not a valuable asset, but compared to health and wealth, it's not valuable at all. Let's move on. Saving and investment. These are the two words. Generally, they are used very frequent, interchangeably. Saving is same, investing is same. Are they same? Quickly, anybody, any view, any answers? So I have a lot of participation coming in. So somebody has said that they are not same. Okay, anybody who thinks they are same? Anyway, let's move on. So obviously they are not same. Saving and investment are two different things, and that's the first thing, first learning we have to take if we want to move ahead in the world of financial services, financial products, financial investing, risk, return, and things like that. So what is the difference? Very quickly, let me highlight. So savings is that we put money aside, is generally for some specific purposes. We have some expense coming up. If we are family, we have our children educational expense coming up, a college fees coming up, a school fees coming up, or we are planning to buy a house that is coming up. We are planning to buy a vehicle, a two-wheeler or a four-wheeler coming up. So then we keep some money aside, and generally that is kept aside in a bank. Generally, savings account is where we keep. Now, that is what is savings. No, but let's keep in mind that that is not investing. Investing is using that money, which, and going beyond savings. So while for some expense we do keep money in a bank is saving, but in a lot of people cases, what happens is that they always keep the money in bank account. Their salary comes, it keeps lying in the bank account. Whenever they need money, they withdraw, they spend whatever is left out. They keep it in the savings bank only. That doesn't give us any return. Anybody has an idea what is the savings interest rate return these days from the banks? You can type your answers in the chat box. Somebody has written 3. No, it's not even 3. I mean, maybe some banks might be offering 3, but most of the larger banks, and I don't want to name banks here, both from public sector as well as private sector, are offering somewhere around 2.5. Some might be 2.25, some might be 2.75. So it's lower than that. And we know inflation today, yesterday only inflation numbers came in, is around 6-7%. So if we keep it in a bank account, that money doesn't give us anything. That 2.5% or even 3%, assuming, is giving us negative return. To come to cover inflation and return higher than that is what we have to move to investing. And investing means using some of your money to invest in the assets which will grow. And those assets are a lot of like equities, shares, mutual funds is what we will talk about. Of course, that comes with risk. It's not risk free. That's a simple rider that we should keep in mind. And I should highlight it at the top that yes, any investing, any expectation of higher return comes with a risk. Okay, somebody has written 7.5% in FD in IDFC Bank, but yes, you know, that's one way to look at it. But that's if one has to go beyond that, what we do. So let's move on. So again, some of the things for savings, generally it is for the short term, generally it is for ready access to cash, involves lower risk. I've already highlighted if you want to move to higher returns in investment, then you have to take higher risk also and earn some basic interest, as I said, 2.5 to 2.75. While investing is usually used for longer term goals, you plan for retirement also, you have to start investing now. You, as I said earlier, you have planned for longer term. You just started your career, you just started earning money after completing your graduation. Over the next 5 to 10 years, you will have planned to buy a vehicle, you will have planned to buy a house, you will have planned to, of course, go for marriage, all these, and then you'll have planned to have kids. All these will need expenses. So to cover for those longer term expenses, you have to do investing. Longer wait to access invested funds. So unlike savings, wherein you can withdraw anytime, investments, there are open-ended funds also, we'll talk about them, but generally one should be ready to keep them locked. Always involves risk. I've already told you this. Please keep this in mind at the top of your mind. Earnings potential, investments typically have the potential for higher return compared to a savings account, and that's why we do. So just a saying that it's a law of nature, inflexible and inexorable, that those who will not take risk will also not get return, can also not win. So some little bit of risk has to be taken. There has to be a balance of risk and return. Obviously, risk and return go proportion. The higher the risk you take, there is an expectation of higher return. But that doesn't mean you can take infinite risk, because if the return doesn't come, risk pans out, then that's a big problem. So at certain moderate optimum level of risk, you have to do investing. If you are finding that complicated, leave it. We can cover those in some of our other topics. So that brings us to the topic of the today. What is a mutual fund? Mutual fund is nothing but a common pool of funds contributed by people who come together. And investments are held in a trust. You can leave the word trust if you find it complicated. There are trustees who are under regulatory control, who manage who look after the investment that you have made. So to that extent, there is some regulatory supervision, although that doesn't guarantee you any returns. More simply put, how a mutual fund works is like this, as I've shown in the slide. Investors, more than one, obviously come together, multiple investors, they pool their money, they give it to a trust, which hires a fund manager, and fund manager manages money in turn on your behalf. The money that he has collected from you, invest in stocks, shares, securities. These are interchangeable words, although there are some finer differences, but for the purpose of this call, and by investing in them, tries to generate a return. That return in turn gets distributed amongst the investors back. Now, as I said repeatedly, that there's no guarantee that these returns, these investments will yield higher returns, although there is a track record that over a longer period of time it does happen. And that's the difference between savings and investments, and specifically the objective of mutual fund. So what are the benefits? Regulatory protection, I have already said this. Risk reduction through diversification. You diversify your assets. Instead of putting money in only 1 or 2 or 5 shares or 5 securities of a company, you put them in 15, 20, sometimes more also. So that reduces your risk. Availability of alternative portfolio objectives. You might have multiple objectives. You can choose according to that. We will come to that. Professional investment management. Now, a general person sitting or doing work or a business may not have knowledge about investing, may not have knowledge about companies. So it is where the professional investment managers, the fund managers, whose job is to continuously track the economy, the market, the working of the company, and as a result try to generate return, is where are look after your funds. Convenience of investment and withdrawal. So there are some locked in funds also, we'll talk about them, but still in general you can invest anytime and withdraw anytime. Unit holder account administration, you can leave that slightly complicated word. Reduction in transaction costs, yes, that's one more thing, we will come to that as well. So when there are benefits, obviously there are risks as well, there are downsides as well, which I highlighted earlier. What are those risks? Market risks. So if you invest in an equity fund, as I said, fund manager will invest in equity shares. Equity market doesn't do well for 1, 2, 3 years, then despite best of the efforts, the equity fund may not give return. Liquidity risk, it's generally not there, but sometimes, especially in debt funds, it tends to come in. Performance risk, yes, of course. So while market doesn't do well, it might so happen that market is doing well, but the fund or fund manager with which you have invested may not be doing well. So that's a risk, and there are no guaranteed returns. Let's keep that in mind. Again, to clarify here very simply, when we put in bank also, we think there is guarantee, but only up to 5 lakh of rupees of bank deposits are guaranteed. Beyond that, if the bank fails, there is no obligation on the bank to return your money. So let's move on. What are the types of the funds? You can keep typing your questions, so I can keep taking alongside, or of course at the end of the session also. So types of funds. This is a classification based on different things, we can say, based on structure, open-ended, close-ended, and interval funds. We'll talk about them. Based on investment objective, debt equity hybrid. Based on style, active and passive. So what are those? Open-ended funds are simply the funds which are available for subscription and redemption at all points of time. You can invest any day that you have surplus money. You can withdraw any day that you want money. Of course, if you are investing in equity funds and if you invest and want to withdraw in a short period of 1 month, 3 months, 6 months, sometimes 1 year also, as I said, if market hasn't done well, then the returns may not be that good. So if that is your objective to get returns in 1 month, invest in 1 month, then you should go in for debt funds and not equity funds. Investors have the flexibility to buy or sell. I have already said this. These funds do not have a fixed tenure, so they are on ongoing funds. And unit capital of an open-ended mutual fund is varying. You can skip that part. An open-ended mutual fund scheme is not obligated. Again, let's skip that for some time. We will come back to that. So as against that, what are the close-ended funds? Close-ended funds are obviously the funds which are not open for subscription and redemption on an ongoing basis. There are certain dates, excuse me, we can call them windows, when they open for subscription, and similarly certain dates when they are open for redemption also. Sometimes those dates could be same of subscription and redemption. Sometimes those dates could be different also. So somebody has said open end, please explain the meaning once again. Open end is nothing but simply it's a fund wherein you can invest anytime. Today, if you have a surplus fund, you go to the mutual fund house, they will accept money in that fund. You need the money back in, let's say, 30 days time, you can redeem it. But close-ended funds are not that way. Close-ended funds are the mutual fund will declare a certain date of investing, and only during that duration you can invest. Similarly, for redemption also, they will have certain dates. Somebody asks, what is the age to start? So legally, you have to be 18 years of age to start, and you should start 18 if you have started earning. Otherwise, as soon as you start earning, you should start investing. Don't wait. In fact, savings and investment, the other difference is that savings, we tend to come in when we are earning 1,000 rupees, we spend 1,000, no saving. No. Investment doesn't work like that. Investment means we are earning 1,000. We have to make sure that we restrict our expenses to 900 and invest that 100 every month. That will give us long-term money. So as I said, close-ended funds are those which will have a specific period open for subscription and a specific period open for redemption. The objective of close-ended funds is that fund manager can make longer-term investment. Here, the idea is that you shouldn't be exposed to the volatility of the market on an ongoing basis. You invest the money today for 3-year, 5-year kind of locked-in period. Then investor gets enough time to invest in companies, give them time that the company is relatively new or even old company, performs well in 1 to 3 year period time. So at the end of 3 years, you get good return. As I said, if you withdraw 3, 6 months, 1 year, first of all, market may be volatile. Secondly, the company itself may not have enough time to be able to generate money enough for the business to give you returns. So that's why these close-ended funds come in. Returns are the same in open-ended and close-ended funds? No, the returns will be different. Exit loads, yes, some of the open-ended funds will have exit load. So depend on the time. If you are investing in an equity fund, generally depends on the scheme to scheme or fund house to fund house. They can have exit load if you redeem within 3 or 6 months. Generally, if you redeem equity fund after 1 year, there is no exit load. So moving on, the other classification based on assets that we invest in equity funds. Equity funds are nothing but the funds in which if you put in money, the fund manager in turn will invest that money into the equities. Equities means, in simple words, shares. The stocks, the companies which are listed on stock exchanges, popularly BSE and NSE. And those, as we know, equity market is quite volatile, continues to keep moving up and down, sometimes very violently and very vigorously. Sometimes event risk. In 2020, we saw how market in a short period of almost less than a month fell 50% when the corona spread news came in. And from there, it recovered well, also more than 100%. So that's what is an equity funds. It carries risk. It is suitable for long-term investing. And so ideally, while there are open-ended equity funds also, but when we invest in equity fund, we should keep it in our mind that we are kind of wanting to invest in a close-ended fund. We will not look at it at least for 3 years, ideally maybe 5 to 7 years also. So that's an equity fund. There you invest for getting good higher returns. By higher returns, what do I mean? I'll first come to debt funds and then explain. So as against equity fund, debt funds are what? Debt funds are the funds in which you invest money. The fund manager in turn will invest in the debt of the companies or bonds, just like we invest in bank fixed deposit, recurring deposits, things like that. A lot of companies raise money through bonds, and there they specify the return that they will give you. depending on the interest rate prevailing in the market and the credit rating of the company. So that return will be 6-7% in the current environment when our interest rates are of that level. So at best, if a fund manager does well, he'll be able to give you 50 basis point, half percentage more in very exceptional cases, 1% more than the prevailing interest rate in the economy. So if interest rate like currently is in the range of 6 to 7%, he can give you 7.5, as I said, at best 8. But going back to equity funds is where you can hope or expect to get 11-12% annualized return if you invest for long term. And let's keep in mind that that is where the inflation is getting covered. Today, the interest rate 6-7%. As I said, inflation in our economy in India is also more or less same at around 6%. So by investing in debt or fixed deposits, you are barely covering the inflation. When you go in the equities, when you actually earn more than the inflation, and that is what the actual earning is. Doesn't mean you should invest 100% of your money in equity. You always have to have a balance of investing into debt and equity. How to start the investment journey as a college student? Somebody has asked. Any resources or learning platforms? So this, our webinar is a learning platform. At NISM, we keep doing a lot of webinars, our learning platforms. I will also talk up more about one or two things very briefly, what NISM can offer you and what can you take as learning platforms. Moving on from debt funds. So these are different kinds of debt funds depending on your horizon. If you have a very short term horizon in the range of 1 month, 1 day to 1 month, you should invest in liquid funds. I'm sorry. And then going on, I will come back to these details if we have time and if we have questions. Just like equity funds, I said at least you should have 3 years plus horizon, going up to ideally 5 to 7 years. In the bond fund also, you can have similar horizons. So as I said, up to 1 month, you have to invest in liquid funds, not necessarily 1 to 3 months also. Then comes ultra short term and debt funds, then floating rate funds, fixed maturity plans. So a lot of categorization. Long term bond funds are also there. Those long term bond funds are something that you can invest for a period of 1 to 2 years, and they will give you higher than the liquid fund returns. These are obviously suitable if you have a planned visibility for the need of the money. You know that certainly in the next 1 to 1.5 years, you are going to need money. Then you should not make the mistake of investing that money in equity funds. At the same time, as I said, since banks won't give you return, these are the funds which come of use, wherein you should invest in bond funds, long-term bond funds or medium-term bond funds for 1 to 1.5 years, and they will give you returns higher than the prevailing equity. The interest rates. As I said, around 7.5-8% they can give you. Hybrid funds are mixed. So as I said, you should not invest in 100% of your money in equity. So what should you do? You should invest in hybrid fund. So hybrid funds, the fund manager on your behalf invest in both debt and equity mix. So he makes sure that 100% of your money doesn't get invested in equity, and so the risk is lesser. At the same time, fund manager makes sure that 100% of your money doesn't get invested in debt, so that you can keep getting better than the inflation covered return. Obviously, the return from a hybrid fund will be return somewhere in between debt to equity funds. And the numbers that I'm quoting are purely for the purpose of understanding. As I said, there are no guaranteed returns. Neither am I saying that you will necessarily get these numbers. But again, for the purpose of understanding, as I said, debt funds, if you get 7%, in equity funds, if you get 11-12%, in hybrid funds, you will get somewhere around 9% odd return. So that's a product that one can choose. Real asset funds. So in India, we have this tendency to invest money into what should I say? Lot of gold investment traditionally, and lot of real estate investment. So today, if you don't want to directly invest into gold, there are some risks. You have to buy a certain quantity. Then there is a problem of safekeeping it. You have to hire a locker in the bank. Otherwise, if there is a theft at home, it can get lost. When you go and sell it again, when you need money, generally 4-5% cut is what a lot of gold traders take it. So as against that, if you invest in gold funds, there are no such risks. You don't actually get the gold, physical gold, but the value that you invest exactly tracks the gold price. And you can invest 1 gram worth of gold, 10 gram worth of gold, 100 gram worth of gold into the financial amount. Whenever you want, you simply redeem, and you will get the value of gold which is prevailing on the day that you want to redeem. Similarly, real estate, if you want to invest in bigger cities, depending on the city and property, you need minimum 30-40 lakhs to going up to many crores. In real estate funds, again, a lot of investors come together. So depending on the fund house, the minimum amount could be 5 lakh, 10 lakh, 15 lakh, 20 lakh. So you can invest that. Of course, these funds, the real estate funds are generally close-ended funds. So the money is locked in and it is not liquid. Gold funds are generally open-ended and you can withdraw anytime. Active funds and passive funds also is something that I touched upon. What are these? Active funds are the funds in which the fund manager takes a call. As I said, all the investors come together, pool their money in a fund hires a professional fund manager, he invests. So in an active fund, he is the one who is deciding that which companies are doing well and will continue to do well. I will invest there. How much I will buy, 2% of the fund, 5% of the fund, 7% of the fund, also I will decide what price he will buy. And when I say fund manager, there is generally a team of fund management professionals. Mostly it is not a single person. So why I'm saying that is that as an investor, your money, you can be reasonably assured is that not dependent on only one person's knowledge, learning or understanding of the market. It's generally a team who sits in the fund house and they take collective decisions. So you can expect that 3-4 people team to up to 10-12 people team will take a reasonably good decision and will give you that benefit. So when that team, I will refer it as a fund manager only, takes a decision, as I said, where to invest, which companies, what price and how much weight, it is called active funds or active fund management. As against that, we have something called passive fund management. So somebody has asked here, what are exactly the ETF? ETF full form is exchange traded funds. I will come to that, don't worry. So going back, passive funds. What are passive funds? Passive funds are simply the funds in which fund manager doesn't take a call of where, how much and when to invest. He simply invests in some indices that are already there. Like popularly in India, we have Nifty, we have BSE Sensex, and then going on from there, we have mid cap index, we have a small cap index, and then these days there are a lot of indices which are there. So when a fund manager says that I will simply track Nifty or invest in Nifty, I will not apply my mind, then that is called passive investing. So when invest in passive investing, what he will do, he will invest if he's tracking Nifty, if he's investing in a Nifty passive fund, he will invest in the same 50 companies which are part of the Nifty. He will invest in these companies in the same weight that their weightage is in the index. So if any company's weight is 12%, he'll keep the 12% weight in his fund also. If any company's weight is 3%, he'll keep the weight of that company in 3% in his fund also. So he will not have 51 companies, he will not have 49 companies, and he will not have a different weight. So he simply tracks the index, and that is called passive fund. Why active and passive funds? In passive funds, if you think that, as I said when I talked about risk in the beginning, there is a performance risk. If you think that fund manager may not perform, you simply invest in Nifty. That okay, I am happy with getting market returns. If market gives me 10%, I am happy with 10. If it gives 12, I am happy with 12. If it gives me 8, I am happy with 8. But at the same time, what is the benefit of active fund? That if your fund manager or fund management team is professionally qualified, learned, they'll do a good investing. And if market or index has given 10% return, it is likely that they will give you 12% return. So you are getting that extra 2% return there. So that's the difference between active and passive. So somebody asked, what are the benefits of passive funds? I have already explained that you don't take exposure to the fund management risk. And of course, for the same reason, the expenses are also lower. How ETF is different from mutual fund? ETF is one of the forms of mutual fund. It is an exchange traded fund. It is a passive fund. It is not a, very simply put, it is not an actively managed fund. Sovereign gold bond scheme is good or bad? It is good. It is good scheme. Sovereign gold bonds is run by Government of India. Government of India has a sovereign guarantee. You are assured of your money, no default. The only thing is sometimes those bonds are illiquid. So while they are listed on stock exchanges, if you need money and if there's no liquidity, if there's no buyer, you may not be able to get money. As against that, exchange traded funds, gold ETF, are always available open for subscription and redemption. At the same time, sovereign gold fund, the additional advantage is that government gives you some marginal interest there. I think 2.5% or something. Does passive fund bear more risk than active funds? No, passive fund has a lower risk, but because of lower risk, you get lower returns also. So let's move on. Some more questions I'll keep answering alongside. Index funds are passive funds. So passive funds are index funds and ETFs. Both of these are passive funds. Very briefly, I'll tell you, index funds, as I said, are aligned to a particular index or a benchmark. I gave you example of Nifty. It can be on Sensex. It can be, in fact, there are funds on mid cap index. There are funds on a small cap index and things like that. As I said, portfolio of such funds replicates exactly the allocation that is there in the index. These funds nearly mirror the performance. What do we mean by nearly? That, and the last point, that they carry with them low expense ratio. There is always an expense of managing money. Some fees fund manager will charge, some fees will be for custodian, accounting, and things like that. So that expense will get deducted from the performance that passive index fund has generated. And that's why the word nearly mirrors. And there will be some expense. And the difference between the performance of index and performance of fund is called tracking error. So that's what an index fund is. There were a lot of questions. As against that, exchange traded fund is nothing but an index fund which is listed on the exchange. The difference is that in an index fund, you directly invest with the mutual fund company and you will only get end of the day NAV. In an exchange traded fund, it is traded on exchange, as the word itself shows, just like shares which are listed. It is listed on exchange and you can buy and sell directly on the exchange. Of course, I'm not taking you in the mechanism. In the back end, there is mutual fund company at the back of every ETF, along with the intermediaries or some market makers who are there in between. So as I said, let's not get into those technicals. But exchange traded fund are traded, listed on the exchanges. You can buy anytime, sell anytime directly on the exchange. For this, you cannot go to mutual fund company. Mutual fund companies website, you can only invest in index funds. And since they are available for trading whole day, you can capture the intraday movement. So if you feel that the market has come down very sharply, Nifty has fallen 100 points, this is the right time for me to buy ETF. You can buy that time. You will get the market price, or so to say NAV of that time. In an index fund, you will only get end of the NAV. And by end, if that 100 points downfall has recovered to -50 or even +50, so then you lose out on that. So that's the difference in the ETF and index fund. Both are, as I said, passive funds. How to invest in index fund, I'll come to that. How to invest in MF website also, I'll come to that. What is ETF? I've already covered. Almost every fund house has an index fund. How can we select one? So that's a different, difficult question. Maybe we can have a separate session on mutual fund selection. But that is something that if you want to do direct investing, what is that? I will come to that. You will have to do your analysis. If you are doing an investing through an advisor, he is the one who will guide you. So very quickly, what is fund of funds? If you find it too technical, just leave it. I've already covered the basic aspects of a mutual fund investing as a good starting point for all of you. So fund of fund, what they do is, as somebody asked, how to select which fund to invest in. These are some fund of funds who collect your money, and like, as I said, equity and bond funds invest your money in shares or bonds of companies. These funds invest your money in other funds. So they are the ones who are doing research to find out from the number of funds that are available in the market from different fund houses, that which of them are doing good, which of them are likely to continue to do good. And they invest in those fund of funds, those multiple funds. And that's why it's called fund of funds. So if you don't understand which company or which fund house to invest in, you can simply invest your money in fund of funds. Of course, there are some disadvantages of that your expenses increase slightly higher. What I mean is that there'll be expenses of the funds in which fund of fund is investing, and then the person who is managing your fund of funds will also charge his own expenses. So marginally your expenses go up. Sometimes there can be liquidity
risk also, which is generally not there, but in a very remote case. At the same time, the benefit is, as I said, it relieves you from the headache of trying to apply your mind, trying to select which funds to invest in, and how to find which are doing well, which will continue to do well. I don't know, we don't know, and things like that. So that's the advantage here. Let's move on. So somebody asked that, okay, how to start investing in mutual funds? Where can I learn about it? Where can I get knowledge? So very briefly, NISM, as the name itself suggests, National Institute of Securities Market Educational Initiative of SEBI, provides a lot of education, content, and learning for investing in various aspects of financial markets, equity shares, derivatives, so many other things, fundamental analysis, technical analysis. Here, since we are specifically restricting ourselves to mutual fund, very briefly, so these are some of the programs that NISM offers. So it offers, we call it Series 5A. You can forget the name for the time, the series for the time being. Remember the name, Mutual Fund Distributor Certificate. So if you want to get into the business of mutual fund distribution, then today SEBI makes it mandatory that you have to have certain basic knowledge for which you have to qualify certain exam. So this is an exam which NISM conducts. If you enroll for this, we supply you the study material also. So that is where you can learn about how to, and even if you don't want to become a distributor, as somebody wanted to know how to know more details about mutual fund, this course gives you more or less complete knowledge about the mutual funds, some of which I covered. Lot more than that that gets covered: how to analyze mutual funds, what are the different types of mutual funds, how the mutual fund companies are structured, legal structure, the resources, the investor grievance mechanism, and multiple other things, taxation and things like that. So this is one mutual fund distribution certificate that NISM offers. The second is again mutual fund foundation certificate. That's the other course, and which again SEBI has mandated it. This is more relevant to some of the constituents, as I said, postal agents. If their organizations want, if these organizations want some of their people to start distributing mutual fund, start making people invest in mutual fund, then they have to ask their employees to compulsorily clear this exam. So retired government and semi-government officials, retired teachers, retired bank officers, all these people, for them it is mandatory to clear this exam. The next point, and this is the last one on NISM. So not only that we provide study material when you enroll for these courses, separately we also provide you learning modules to know about mutual funds, and you don't have to come or go anywhere out of your home. These are all today at the very convenience of your home. These are e-learning modules, and this is very small learning module of 4 hours. You can simply enroll on our website. I've given the links here, and you will get access to all the 4 hours of knowledge that is there online. As I said, you don't have to waste time in going, traveling, finding out that the center is not there in your city, so you have to go to another city, spend money for that. Nothing like that. This is an e-learning module available for mutual fund investing to know all about mutual fund. So I'm more or less coming to the end of my session. If you have some more questions, you can start typing in the chat box, and I start asking, and we can cover those. I have my colleague Raj Lakshmi also with me. If you have any other questions on NISM, on the courses that we offer, we offer multiple courses for students who want to make a career in financial market. We can take those questions as well. So somebody has a question here. I am a chartered accountant and wish to start my career in capital market, but I don't have experience. How can I start? I have completed an NISM research analyst certification. So good that you have completed the analyst certification. These are basic requirements. How to start? I think you will probably have to take some more lessons on investing, not investing necessarily, but capital market is a vast field. So again, within that, you have to define whether you want to do mutual fund, you want to do equity, you want to do bonds, or you want to do other products, and take more courses on that. And just like anybody starts any business, then you have to start working on that. Okay, some more questions. How to get internship in financial market? Let me see if I can answer that. Which type of fund is suitable for retired people? So generally the bond funds are more suitable for retired people, but there is a whole lot of concept of wealth management, wealth planning, which goes in. If you have enough cushion which can take care of your expenses for the projected life period that you will have, then you can take exposure to equity funds also, because they will cover your inflation. While, as I said, for retired people you should invest in debt funds, but they barely cover your inflation, and that's the biggest problem which comes in the retired phase of life, that your earnings are either not there or are limited. In some cases you get pension, in a lot of cases you don't get that. So if your earnings from your investment are not covering inflation, then that's a difficult part. So if you have extra money, you should invest in equity as well. But otherwise, as a very simple answer, bond funds is something that one has to invest in. Can you tell something about NISM Series 10A investment advisor? Today we are not covering that, but in one of the website, one of the webinar, we will cover that, and that's the time we can tell you about that. How to renew mutual fund distributor certificate. I think if you do online search, you will probably be able to get. First of all, you will have to clear the research analyst exam. If you're not done that, if you've done that and if it is expired, you'll have to reappear and then apply on SEBI's website. I think there is SI portal or something for renewing your mutual fund distributor certificate. What is SIP? Something has asked. Okay, I will try to answer that question. I've held it on. Then somebody has also asked how to invest in mutual funds. Okay, so let me come to those since we have some more time. I had kept them at the backup so that I can answer your questions and then take those. So before that, very quickly, what are the types of plans? There are direct plans and there are standard plan or regular plan. So what SEBI did is, few years ago, it said that a lot of investors probably have enough knowledge, so they don't want to go to the distributor. They can study and analyze mutual funds on their own. Whether you can or not, please decide for yourself. So if you can, then you can directly invest in the direct plans and the expenses will be lower. But if you don't have that knowledge or learning, then you should necessarily go through a distributor advisor, in which the expenses will be higher, but at least you know that somebody who understands is guiding you. So these are the two differences of direct plan and regular plan. As I said, the cost is different. Direct plan cost is lower, but you should know. If you don't know, go to regular plan. Cost will be higher, but you should consider that as a fees that you are paying to somebody. So somebody has asked, is recommended to go in for distributor to invest in mutual funds? As I said, you decide. If you think you have gained enough knowledge of analyzing mutual funds, studying them, will be able to monitor them on an ongoing basis, will be able to monitor their performance, underperformance, do it directly. If not, if you are working in a full-time job or a career or a business, you run your own shop, you run your factory, you are working in a factory, in a production floor, you don't get any time to monitor your investment, necessarily go through a distributor. How to start a career in a mutual fund manager? There are a lot of questions related to career. So in another 5 minutes or so, I will hand over the floor to my colleague Raj Lakshmi. She will answer all those questions. Let me quickly take last few questions on mutual funds and investments and things like that. Till today, I've never invested in mutual fund, but the session has made my concept clear. So thank you very much. But still, I would reiterate that understand all the risk very clearly. Make sure that you have enough time to devote on investing. On which type of fund least tax is levied? So while this is not a taxation class, but very quickly, there are long-term and short-term capital gains tax. If you sell any mutual fund holding less than 12%, less than 12 months, short-term capital gains taxation, equity funds 15% is charged. If you hold for more than 12 months, long-term 10% is charged. In debt funds, there is a complete different, depending on your business income, depending on your indexation benefit and things like that. There are a lot of other criteria. So please understand that very well before taking that.
Sir, I would like to interrupt.
Yeah, go ahead, Rajlakshmi.
Sir, there are many of our viewers who are watching it live on LinkedIn as well. So some of them have a few of the queries. So I can put it
So,
here if you would like to answer
or you
that.
start quickly reading from there related to
Sure,
investment. I'll take for next
sure,
few
sir.
minutes, and then related to career and all, you take after that.
Sure, sir. Sure,
Yeah.
sure.
Yeah. So read out,
Sir,
please.
one of the person has asked, I have invested for hybrid fund. So is it good to invest in equity fund for my retirement purpose?
No, not for retirement, certainly not. As I said, for retirement, you should either focus on bond funds or it's okay to invest in hybrid funds. But it is a very simplistic answer. As I said, if you have enough expenses covered by investing in debt funds, which you think that you will be able to, as I said, cover your expenses for the expected life period. Then, and if there is a surplus money after that, please invest in equity fund because that's where you will cover the inflation. And as I said, take help of an distributor or an advisor to guide on that properly. Yeah, next.
Okay. Sir, Mr. Harshit is asking, what is the difference between index fund and ETF?
So as I said, let me quickly repeat, index fund, you buy from a website of a mutual fund company. ETF, you can directly buy on the stock exchange. That is a procedural difference. In terms of benefit difference, the ETFs both have lower cost. Within that, ETF has a slightly lower cost than the index fund. And the third and the biggest difference is that in ETF, you can catch the NAV or the value of intraday movement of the market. In an index fund, you will only get the end of the day value NAV, whichever level the market closes. Next.
Okay, sir. So Ms. Kanchan Sharma is asking, I have done NISM Investment Management Level 2 certification. I am interested in capital markets. I'm a qualified CS and CMA, so have a fair understanding of finance. So what do you suggest? So this is a question from Ms. Kanchan.
Yeah. So I mean, I don't have much to suggest, but let me assume that you are asking that maybe as a carrier, what should you do? So there are two things which I can interpret. As I said, I can't interpret much from your question. One, you can start investing on your own. You have a reasonably good theoretical, analytical knowledge, which will get refurbished, refreshed, and benefit of experience when you actually start doing investing. So that is one thing you should do. Secondly, if you are looking to make it as a career, please start that. Make sure you have all the regulatory permissions as required by SEBI in place. You have already done certifications. Do registration, go on the SEBI website or whatever as process suggested by the SEBI. Do those registrations and start marketing yourself to the client, start advising them to invest in. Yeah, next.
Okay. More or less all the queries are covered from LinkedIn.
Okay, here are one or two more questions. Suggest some tax saving fund. So unfortunately, that's not the thing that we want to cover. That we give you names of which of the fund houses and which of the funds. As a neutral educational body, it doesn't look good on our part to talk of some specific players. As I said, either analyze on your own or take help of an advisor or a distributor. So we will come back to questions. Let me quickly cover one or two things more which I was holding on, and which some people ask also. So in addition to direct and standard plan, you have dividend option or a growth option which you can choose. So in a growth option, your money will keep growing, won't come to you. But if you want that for some reason, especially retired people, or if you want some expense money to keep coming to you on an ongoing basis, you can choose the dividend option. So whenever the fund house declares dividend, that money will get credited into your bank account. In a growth option, it simply keeps getting accumulated. So some people feel that this money has come in and I end up spending it. Instead, it would have been good if it didn't come to me. So in a growth option, it won't come and it will keep getting accumulated. For you, the NAV will keep going up if the fund is doing well. How to invest in mutual funds? Somebody asked. So it's again a vast subject, but very simply, I tried to put it in one side. One, of course, simply via physical mutual fund application form. So most of the mutual fund companies have their offices in most of the major cities. Certainly large 30-40 cities. Some of them have gone beyond that. Additionally, these companies have registrar. Most of them are either CAMS or I think K FinTech. Some of them maybe one or two more. My idea is not to market, but since these are very limited numbers, I am taking these names. So these registrars also have their physical offices in most of the cities. If you Google these things, you will find their addresses. You can go to their office. They'll give you a form, give you fill the form, give you a check. They ask for Aadhaar and things like that. Give that. So that's physical. Of course, you can do online. So you can directly go on the website of mutual fund, especially if you are investing in direct funds, direct plans, you can invest there. Of course, when you invest in the website of mutual funds, they also give you an option to choose if you want to invest in a standard plan, and in that case, who is your advisor, you can do that. Third option these days, mobile app of most of the mutual funds. You have the mutual funds companies apps also, and you have app of lot of aggregators also, and you have app of lot of big advisor or distributors. You can do that. And fourth, as I said, via AMFI registered mutual fund distributors. Again, through those distributors, those distributors have their own website, they have their own apps. You can choose, or they have the physical. You can go into any bank, they do mutual fund distribution. You can invest there. So that's how you can invest. Somebody asked what is SIP. There are three words: is systematic investment plan, STP, and SWP. SIP is nothing but systematic investment plan, wherein you allocate a fixed sum of money as low as 500 going up to 5 lakh 5 crore every month on a fixed date. It automatically gets deducted from your bank account and gets invested. So it gives you a discipline, plus it covers the market averaging for you. So that's the biggest advantage of SIP. And then you don't have to remember every month that I have to invest. So that's the biggest advantage of SIP, and that is what a SIP is: systematic investment plan. Where can I prepare for NISM certification? As I said, come to the NISM website or send a query separately on NISM helpline. Besides giving you registration for doing the certification, we give you the course material and certification help also. What course do you suggest to manage his or her own finances? Different product, different courses. We have investment advisory module, which covers all the products. We have mutual fund module. We have something on PMS. On equity, we have a lot of things, fundamental analysis, technical analysis, derivative. So depend where do you want to invest in that. Is there an online portal to use a mutual fund distributor once we clear the NISM certificate? Yes, there are many. You can do that. I am a BCom first year student. I want to know if investing mutual funds safe for long term. So safe is a very generalized word. As I said, every investment comes with risk. But yes, if you invest for long term, it is generally safe. So let me again keep coming back. Something more on SIP. I have largely covered what I said, which is mentioned in this slide. So the advantage is you don't have to remember automatically money gets deducted from your bank and keeps getting invested. STP, systematic transfer plan. So if you don't want to keep your money in bank, as I said, of a very low return, you can invest in a debt fund of a mutual fund, all your money, and give an instruction that keep transferring certain part of my money on a monthly basis to equity fund. So what happens is that your debt fund investment gets you higher than the bank return, generally, not always, and you keep getting advantage of market averaging. Sometimes in the month market will fall, you will get a lower NAV, higher units allocated for same 1,000 rupees. Next month market will go up, your NAV will be higher, you will get lower number of units, but you are able to cover the fluctuations of the market. So that's what an STP helps you in. And similarly, what is a SWP? Is a systematic withdrawal plan. Just like in SIP and STP, you invest fixed sum of money. In SWP, you can withdraw. This is more suitable for retired people, that they don't have to have the hassle of putting in redemption every month or deciding how much money they want in. They can decide fixed sum of money, which they think is their expense, decide on the date that they want to get that money, and that money will keep coming to you. The balance of the money will keep getting remain invested, and will continue to get you returns. So I guess finally I have covered all the aspects that I wanted to cover in. That's all that is there. Is ELSS fund fully tax free? So the amount that you invest in, you get some redemption. I'm not a tax expert, so I don't exactly know this, but yes, there is some benefit of taxation in ELSS. Good. If there are anything else, Rajlakshmi, especially on admissions, career courses and all, you take over, and maybe I can now become a silent spectator on or
Sure.
exit also. Is that
Sure,
okay?
sir. Sure,
Thank
sir.
you. Thank you, everybody.